When you set out to build wealth, you are not relying on magic, lottery tickets, or viral trends. You are relying on disciplined, repeatable financial strategies applied consistently over time. The idea that you need millions to begin is a myth designed to keep people passive. In reality, the stock market has historically rewarded those who understand its mechanics, not those who chase hype or gamble on tips. You do not need to be a genius or have insider connections. What you need is clarity on how compounding works, how to identify undervalued assets, and how to stay emotionally detached from market noise. This is not motivational fluff. It is math. And math does not care about your background, your salary, or your starting point. It only responds to consistency, patience, and intelligent allocation. The core principle behind building wealth with little money is leverage. Not the dangerous, debt-fueled kind, but the strategic kind, leveraging time, reinvested dividends, and ownership in businesses that grow regardless of economic cycles. You are not betting on stocks. You are becoming a fractional owner of real companies that generate real cash flow. That shift in mindset is what separates long-term accumulators from short-term gamblers. When you buy a share, you are buying a piece of a machine that ideally keeps producing value year after year. Your job is to find machines that are durable, scalable, and underpriced relative to their future output. Most people fail because they treat the market like a casino. They jump in during hype cycles, panic when corrections hit, and sell at the worst possible time. Then they blame the market instead of their own behavior. The truth? The market does not owe you anything. It does not care about your dreams or your rent payment. It only rewards those who respect its rules. Valuation, diversification, and time horizon. If you are starting with $500 or $5,000, your advantage is not size. It is flexibility. You can move quickly, ignore institutional noise, and focus purely on fundamentals without the pressure of quarterly reports or shareholder meetings. The three stocks we will discuss are not speculative moonshots or meme-driven gambles. They are businesses with proven business models, strong balance sheets, consistent cash generation, and leadership that thinks in decades, not quarters. These companies have survived recessions, adapted to technological disruption, and expanded globally without losing operational efficiency. That is the kind of resilience you want when you are starting small and aiming big. You are not looking for 10 times returns in 6 months. You are looking for 10% annualized returns over 20 years. That is how small sums become millions. Let us be brutally honest. If you are expecting to turn $1,000 into $1 million in 12 months, you are in the wrong place. This strategy is for people who understand delayed gratification. It is for those who would rather build real, lasting wealth slowly than gamble it all on a crypto pump or an influencer stock tip. The beauty of this approach is that it scales. Whether you invest $50 a month or $5,000 a month, the principles remain identical. The only variable that changes is time, and even that can be compressed if you increase your savings rate intelligently. One of the biggest mistakes beginners make is overcomplicating things. They read 50 books, follow 20 analysts, and end up paralyzed by conflicting advice. You do not need complexity. You need conviction in a simple, evidence-backed system. Buy excellent businesses at fair prices. Hold them through volatility. Reinvest dividends. Add capital when you can. Ignore the talking heads. Rinse and repeat for 15 to 25 years. That is the entire playbook. Everything else, options, leverage, sector rotation, is optional and often counterproductive for small investors. Another critical factor is cost control. Every dollar you pay in fees, commissions, or taxes is a dollar that cannot compound for you. That is why choosing low-cost brokers, tax-efficient accounts like IRAs or Roth IRAs in the United States, and ETFs or direct stock purchases without hidden fees is non-negotiable. If you are paying 1% in annual fees, you are giving up a massive chunk of your future returns. Over 30 years, that 1% could cost you hundreds of thousands, or even millions, depending on your portfolio size. Efficiency is not glamorous, but it is essential. Emotional discipline is just as important as financial discipline. When the market drops 30%, you will not find me posting panic videos or selling everything. I will be buying because that is when quality assets go on sale. Volatility is not your enemy. It is your ally if you are a net buyer over time. Most investors lose money not because they picked bad stocks, but because they sold good stocks at the worst time due to fear. If you cannot handle a 20% drawdown without losing sleep, you are not ready to invest in individual equities, and that is okay. Start with index funds until you build emotional resilience. This strategy is not theoretical. It has been proven across generations by ordinary people who followed simple rules. Live below your means, invest the surplus consistently, own businesses that compound, and never interrupt the compounding process unless absolutely necessary. Teachers, nurses, mechanics, and postal workers have all retired as millionaires using this exact method. Not because they were brilliant, but because they were consistent. You do not need to be special. You just need to start and not stop. So if you are serious about building real wealth from a small base, forget get-rich-quick fantasies. Forget chasing the next hot stock. Forget listening to financial TV. Focus on ownership, valuation, and time. The 3 stocks we will break down next are not just tickers. They are economic engines with decades of runway ahead. And if you buy them at reasonable prices and hold them like an owner, not a gambler, you will be shocked at what is possible, even starting with very little. This first company does not make headlines with flashy product launches or celebrity endorsements. It does not trend on Reddit or get hyped by influencers. What it does do relentlessly, predictably, and profitably is generate cash. Every single quarter. In bull markets and bear markets. During pandemics and political chaos. That is the kind of business you want when you are building wealth from scratch. One that does not need your attention to keep working for you. This is a set-it-and-forget-it asset, but only if you understand why it works and how to value it correctly. The core of this business is recurring revenue. Not subscriptions in the tech sense, but contracts, maintenance agreements, consumables, or essential services that customers cannot easily cancel or replace. Think industrial equipment servicing, medical consumables, enterprise software licenses, or logistics infrastructure. These are boring industries, which is exactly why they are so powerful. Boring means stable. Stable means predictable. Predictable means you can model future cash flows with high confidence. And that is the foundation of intelligent investing. Financially, this company exhibits 3 non-negotiable traits. High gross margins, typically above 60%, low capital expenditure requirements, meaning most profits are free cash flow, and consistent return on invested capital above 15% for at least 10 consecutive years. These metrics are not arbitrary, they signal efficiency, pricing power, and management discipline. If a company cannot generate high margins or reinvest capital profitably, it is not a wealth-building machine, it is a job creator for consultants and turnaround specialists. What makes this stock especially attractive for small investors is its scalability without proportional risk. As the company grows, it does not need to take on massive debt or dilute shareholders. It grows organically through reinvestment of retained earnings and strategic bolt-on acquisitions, often paid for in stock or cash, not leverage. That means your ownership stake compounds in value without being watered down. Compare that to high-growth startups that constantly raise capital at the expense of early shareholders. This is the opposite model. Slow, steady, and shareholder-friendly. Global reach is another critical advantage. This company does not rely on one country, one customer, or one product line. It operates in dozens of markets, serves thousands of clients, and generates revenue in multiple currencies. That diversification insulates it from regional recessions, political instability, or sector-specific downturns. For you, as a small investor, that means lower volatility and higher probability of uninterrupted compounding. You are not betting on Brazil's economy or Europe's recovery. You are betting on human infrastructure needs that exist everywhere, all the time. Management matters, and in this case, it is exceptional. The CEO and CFO have been in place for over a decade. They do not issue flashy guidance or host flashy investor days. They focus on operational efficiency, margin protection, and returning excess capital to shareholders via dividends and buybacks. Their compensation is tied to long-term ROIC and free cash flow per share, not short-term stock price manipulation. That alignment between management and shareholders is rare, and incredibly valuable when you are investing for decades, not quarters. Valuation is where most investors get this wrong. They see a boring company trading at 25 times earnings and assume it is expensive. But if that company grows earnings at 8 to 10% annually, pays a 3% dividend, and buys back 3 to 5% of its shares yearly, your total return potential is 14 to 18% before any multiple expansion. That is not expensive, that is efficient. And during market corrections, when panic sells hit, this stock often drops not because its business is broken, but because traders flee slow growers. That is your buying opportunity. Dividend policy is intelligent, not generous. The company does not pay out 80% of earnings to please retirees. It pays out 30 to 40%, reinvests 40 to 50% into high-return projects, and uses the rest to reduce share count. That balance ensures growth is not sacrificed for yield, and yield is not sacrificed for growth. For you, that means a growing income stream plus capital appreciation, the holy grail of long-term investing. Reinvest those dividends, and your ownership stake grows even faster without you lifting a finger. Competitive advantage, or moat, is wide and deep. Whether it is proprietary technology, regulatory licenses, customer switching costs, or economies of scale, this company operates in a space where new entrants face massive barriers. It is not invincible, no company is, but it is resilient. It has survived technological disruption, labor shortages, supply chain crises, and interest rate spikes. That track record is not luck, it is structural strength. And structural strength is what protects your capital when markets panic. If you are starting with little money, this stock is your anchor. It will not 10 times overnight, but it will grow steadily, pay you while you wait, and compound relentlessly. Buy it on dips. Add to it with every paycheck. Ignore quarterly noise. Let time and reinvestment do the heavy lifting. This is not a trade. It is a decades-long partnership with a machine that knows how to turn capital into more capital, with or without your daily attention. Infrastructure is not glamorous, but it is unavoidable. Every economy, every business, every household depends on it. Transportation, energy transmission, data networks, water systems, logistics hubs, these are the arteries of modern civilization. And this second stock does not just participate in infrastructure, it owns, operates, and monetizes critical pieces of it across multiple continents. That is not a growth story, it is a necessity story. And necessity does not go out of style even in recessions. What separates this company from typical infrastructure stocks is its business model. It does not build roads or lay pipes for governments. Instead, it owns and operates high-utilization assets that charge users directly. Think toll roads, data centers, port terminals, or energy pipelines with long-term contracts. These assets generate predictable, inflation-linked cash flows because their services are essential and often monopolistic within their regions. Customers do not choose whether to use them, they have to. That is pricing power you cannot replicate with marketing or innovation. Financially, this company is a cash flow beast. Revenue visibility is measured in decades, not quarters, thanks to contracts that are often 10 to 30 years long with built-in annual price escalators tied to inflation. That means even if the economy slows, revenue does not, it actually grows in real terms. Operating margins are consistently above 50% because once the asset is built, maintenance costs are low and labor requirements are minimal. Most of the revenue drops straight to free cash flow, which is then used to pay dividends, reduce debt, or acquire more assets. Geographic diversification is a core strength. The company operates in North America, Europe, Asia, and Latin America, but not randomly. It targets regions with growing populations, rising middle classes, and underdeveloped infrastructure, meaning long-term demand tailwinds are structural, not cyclical. Even if one region enters a recession, others are growing, smoothing out overall performance. For you, as a global investor with limited capital, this provides built-in hedging without needing to manage multiple country-specific positions. Inflation is often seen as an enemy of investors, but for this company, it is a tailwind, because its contracts include automatic price adjustments based on CPI or local inflation indices. Revenue rises with inflation without requiring additional investment. That is rare. Most companies struggle to pass on cost increases. This one does it automatically by contract. That protects your purchasing power and ensures real returns over time. In a world of persistent inflation, that is not just nice to have, it is essential. Management strategy is acquisition-driven, but disciplined. They do not chase transformational megadeals that destroy shareholder value. Instead, they target small to mid-sized assets in their core sectors, pay reasonable prices, typically 10 to 15 times EBITDA, integrate them efficiently, and immediately start extracting synergies. Their track record of post-acquisition performance is exceptional, which is why the market rewards them with a premium valuation. They know their lane and they stick to it. Balance sheet strength is non-negotiable in this sector, and this company delivers. Debt to EBITDA sits around 3 times, conservative for an infrastructure player, and most debt is long-term, fixed rate, and hedged against currency fluctuations. That means no refinancing risk in rising rate environments and no exposure to forex volatility. Interest coverage is above 5 times, meaning earnings comfortably cover debt payments even in downturns. For small investors, this reduces the risk of catastrophic failure, which is critical when you cannot afford to lose capital. Dividend policy is sustainable and growing. Payout ratio hovers around 60 to 70% of free cash flow, high, but justified by the stability of the underlying cash flows. The dividend has increased every year for 15+ years, often by 5 to 8% annually, outpacing inflation and growing your income stream without you doing anything. Reinvest those dividends, and your yield on cost compounds dramatically over time. This is not a dividend trap. It is a dividend engine. Valuation is often misunderstood. Because the company trades at 18 to 22 times earnings, many label it expensive. But when you factor in 6 to 8% annual growth, 4 to 5% dividend yield, inflation protection, and global diversification, the total return profile is compelling. And during market sell-offs, when speculative stocks crash, this one often holds up, or even rises, because investors flock to essential, cash-generative assets. That is when you add to your position. If you are starting with little money, this stock gives you global exposure, inflation protection, and growing income all in one package. It is not going to make you rich next month. But over 15 to 20 years, with reinvestment and compounding, it will quietly turn small sums into life-changing wealth. Buy it, hold it, add to it. Let the world's infrastructure needs work for you, whether the market is up, down, or sideways. The third stock on this list operates in a space so unglamorous, so overlooked, that most investors do not even know it exists, until they realize how much of the global economy depends on it. This is not consumer tech, electric vehicles, or AI chatbots. This is industrial-grade, B2B, mission-critical hardware and software that keeps factories running, hospitals functioning, and supply chains moving. And this company does not just participate in this niche, it dominates it. With 60 to 80% market share in several key product categories, it is the undisputed leader in a space with almost no viable competition. What makes this dominance sustainable? 3 things: proprietary technology protected by decades of patents, customer lock-in through integrated systems that are prohibitively expensive to replace, and a global service network that ensures uptime is measured in 5 nines, 99.999% reliability. Once a manufacturer, hospital, or logistics provider installs this company's systems, they rarely, if ever, switch. The cost of migration is not just financial, it is operational chaos. That is the kind of moat you cannot replicate with venture capital or clever marketing. Financial metrics are extraordinary. Gross margins consistently above 70%. Operating margins above 30%. Return on equity above 40% for over a decade. These are not software-as-a-service margins, this is industrial hardware and software hybrid, achieving tech-like profitability because of its pricing power and scale. The company does not compete on price. It competes on reliability, integration, and support. And customers happily pay premiums for that, which is why margins keep expanding even as volumes grow. Growth is not explosive, it is consistent. Annual revenue growth averages 6 to 9%, driven equally by unit expansion, price increases, and service contract renewals. But because margins are so high and capital expenditure is so low, Most new products are software updates or modular upgrades. Free cash flow conversion is nearly 100% of net income. That means almost every dollar of profit is available for reinvestment, dividends, or buybacks. For small investors, that efficiency is golden. Your capital is being put to work immediately, not tied up in factories or inventory. Global footprint is strategic, not scattered. The company has major operations in North America, Germany, Japan, and South Korea, the world's most advanced industrial economies. It does not chase emerging markets with unstable regulations or weak IP protection. Instead, it focuses on regions where its technology is mission-critical and customers value reliability over cost. That focus reduces execution risk and ensures high returns on every dollar invested abroad. Management is engineering-driven, not finance-driven. The CEO came up through R&D, not investment banking. Decisions are made based on product lifecycle, customer uptime, and system integration, not quarterly EPS targets. That long-term orientation shows up in the numbers. R&D spending is high, 8 to 10% of revenue, but it is focused on incremental improvements that deepen customer lock-in, not moonshots that burn cash. This is not a company trying to disrupt itself. It is a company optimizing its dominance. Valuation appears high at 30 times earnings, until you realize you are buying a near monopoly with 70% plus gross margins, 30% plus operating margins, 40% plus ROE, and double-digit free cash flow growth. In a world where most growth stocks are burning cash and diluting shareholders, this company is a fortress. And because it is boring and industrial, it rarely gets re-rated upward during bull markets, which means you can often buy it at reasonable valuations during sector-wide sell-offs. Dividend policy is conservative but growing. Payout ratio is around 25 to 30%, low by design, because management prefers to reinvest in high-return projects and buy back shares. Share count has declined 3 to 5% annually for the past decade, meaning your ownership stake grows even if you never buy another share. Reinvest dividends and your compounding accelerates further. This is not an income stock, it is a total return compounder. Competitive threats are minimal. New entrants face decades of catch-up in technology, certifications, and customer trust. Incumbents are either too small to scale or too diversified to focus. Private equity cannot replicate the R&D engine or global support network. This is not a moat. It is a fortress surrounded by a moat, guarded by dragons. And those dragons are patents, service contracts, and customer dependency. For small investors, this stock is a stealth wealth builder. It will not trend on Twitter. It will not be on CNBC. But quietly, year after year, it will compound your capital at 12 to 15% annually through a combination of earnings growth, margin expansion, share buybacks, and dividend reinvestment. Buy it. Forget it. Check in once a year. Watch your ownership stake grow. Let the industrial world's invisible backbone make you rich, slowly, surely, and silently. Building wealth with little money is not about picking the perfect stock or nailing the perfect entry point. It is about constructing a simple, resilient portfolio and adding to it relentlessly over time. The three stocks we have discussed are not meant to be traded, they are meant to be owned. And the way you allocate capital to them matters far more than trying to predict short-term price movements. Let us break down exactly how to structure your holdings, when to deploy cash, and why waiting for the dip is often the most expensive mistake small investors make. Start with equal weighting. Allocate 1/3 of your investable capital to each stock. Not because they are equally risky or equally rewarding, but because you are not smart enough, and neither am I, to know which one will outperform over the next decade. Equal weighting forces discipline. It prevents you from over-concentrating in the hottest stock of the moment, which is usually the one most likely to disappoint. Rebalance annually. If one stock grows to 45% of your portfolio, sell enough to bring it back to 1/3 and buy the laggards. This is mechanical, not emotional. Never invest lump sums based on conviction. Instead, use dollar-cost averaging, especially when starting small. If you have $3,000 to invest, do not dump it all in one day. Split it into 6 to 12 monthly purchases. This smooths out entry prices and removes the psychological burden of buying at the top. More importantly, It builds the habit of consistent investing, which is far more important than perfect timing. Time in the market beats timing the market. Every empirical study confirms this. Buy more when prices fall, but only if the business has not deteriorated. A 20% drop in stock one is not a warning sign. It is a sale. Use volatility to your advantage. Keep a simple checklist. Has the company lost pricing power? Are margins collapsing? Is management making reckless acquisitions? If the answer is no, then the dip is an opportunity, not a red flag. Small investors have a massive advantage here. You can be greedy when others are fearful because you are not managing billions or answering to clients. Ignore macroeconomic forecasts. You do not need to predict interest rates, inflation, or election outcomes to succeed. These three companies are built to perform in any environment. Inflation helps stock 2, recessions do not kill demand for stock 1 services, and stock 3's customers cannot switch even in downturns. Your job is not to forecast the economy, it is to own businesses that thrive regardless of it. That is the definition of resilience. Reinvest all dividends automatically. Do not spend them. Do not wait for a better entry. Turn on DRIP, dividend reinvestment plan, in your brokerage account and let compounding work invisibly. Over 20 years, reinvested dividends can account for 40 to 60% of your total returns, even in moderate yield stocks. This is free money that requires zero effort. Ignoring it is like leaving cash on the table. Track performance annually, not daily. Open your portfolio once a year. Check. Are all three businesses still executing? Are financial metrics stable or improving? Has management changed strategy? If yes, stay the course. If something fundamental has broken, replace that holding, but only after deep research, not panic. Most portfolio reviews should take 30 minutes, not 3 hours. Complexity is the enemy of small investors. Tax efficiency matters. If you are in the United States, use tax-advantaged accounts, Roth IRA, for 401k, for long-term holdings. If you are in another country, find equivalent structures. Avoid frequent trading in taxable accounts. It generates short-term capital gains taxed at higher rates. These three stocks are meant to be held for decades, so structure your accounts accordingly. Paying unnecessary taxes is one of the silent killers of compounding. Emergency fund first. Never invest money you might need in the next 3 to 5 years. If you do not have 3 to 6 months of living expenses in cash, build that before buying a single share. Investing without a safety net turns you into a forced seller during downturns, which is the fastest way to lock in permanent losses. Wealth building requires stability, not heroics. Ignore noise. Turn off financial news. Unfollow stock tipsters. Mute finance influencers. None of them will be there when you retire. None of them care about your goals. Your portfolio does not need daily attention. It needs annual checkups and consistent additions. The more you watch prices, the more likely you are to make emotional decisions. Set calendar reminders. Automate contributions. Walk away. This is not a strategy. It is a system. Simple, repeatable, evidence-based. It does not require genius. It does not require luck. It requires discipline, and that is something anyone can learn. Start small. Stay consistent. Let time, compounding, and business fundamentals do the heavy lifting. You do not need to be right every day, you just need to not be wrong for 20 years. Every investment carries risk, but not all risks are equal. The goal is not to eliminate risk, impossible. It is to understand it, price it, and mitigate it intelligently. These three stocks are among the most resilient you can own, but they are not bulletproof. Let us break down the real risks each one faces, why most of them will not matter over a 20-year horizon, and how to structure your life so that even if things go sideways, you will not panic sell at the worst possible time. Stock 1's biggest risk? Disruption. A new technology could theoretically make its products or services obsolete. But given its entrenched customer contracts, high switching costs, and continuous R&D investment, the probability is low, and the timeline is long. Even if disruption begins, you will have years, not months, to adjust. Monitor R&D spending and customer retention rates annually. If both stay strong, the moat is intact. Stock 2's primary risk is regulatory or political. Governments could try to cap tolls, seize assets, or impose windfall taxes. But because this company operates globally and structures contracts with arbitration clauses and inflation-linked escalators, single-country risk is limited. Diversification protects you. Also, infrastructure is rarely seized, it is too critical. More likely risk: interest rate spikes increasing refinancing costs. But the company's fixed rate, long-term debt minimizes this. Stock 3's vulnerability: technological leapfrogging. A startup could theoretically invent a better, cheaper alternative. But given the decades-long certification cycles, integration complexity, and customer risk aversion in its industries, adoption would take 10 to 15 years, if ever. Meanwhile, the company is acquiring or licensing adjacent technologies to stay ahead. Monitor patent filings and R&D pipeline, not stock price. Market risk: the fear of crashes is mostly psychological. Yes, your portfolio will drop 30 to 50% at some point, probably multiple times. But if you are investing new money every month, crashes are your friend. They let you buy more shares at lower prices. The only real danger is selling during the crash. That is why you need an emergency fund and a long time horizon. If you might need the money in 5 years, do not invest it. Period. Concentration risk is real. You are only holding 3 stocks. But they are in unrelated sectors: industrial services, global infrastructure, niche hardware/software, operate in different geographies and have different revenue drivers. That is diversification enough for a small portfolio. Adding more stocks just adds complexity without reducing risk meaningfully. Better to deeply understand 3 than vaguely know 30. Inflation risk: actually, these 3 stocks benefit from inflation. Stock 1 raises prices annually. Stock 2 has CPI-linked contracts. Stock 3's customers cannot switch, so price increases stick. Your purchasing power is protected, unlike bondholders or cash savers. Inflation is not your enemy here. It is your silent partner. Liquidity risk: none. All 3 stocks trade millions of shares daily on major exchanges. You can buy or sell anytime during market hours without moving the price. Unless you are investing billions, you are not. For small investors, liquidity is a non-issue. Management risk: always present. If the CEO retires and the successor is a bean counter instead of an operator, performance could suffer. Mitigation: read annual reports. Listen to earnings calls. Watch for changes in capital allocation, sudden M&As, dividend cuts, share issuance. If management quality declines, replace the holding, but only after confirmation, not rumor. Black swan risk: pandemics, wars, AI takeovers, none of these break the core thesis. People will still need industrial maintenance, stock 1, infrastructure, stock 2, and mission-critical hardware, stock 3. These are not discretionary purchases, they are economic necessities. The world could descend into chaos, and these companies would still generate cash. The only real risk you cannot mitigate: your own behavior. Panic, impatience, FOMO, overconfidence. That is why you automate investments, ignore noise, and review only annually. Build a life outside your portfolio. Have hobbies, friends, career, purpose. The less emotional weight you place on daily stock movements, the more likely you are to hold and win. Risk is not in the market. It is between your ears. Turning small sums into millions is not magic, it is arithmetic. Let us run the actual numbers so you know exactly what is possible, what is required, and what milestones to expect along the way. No hype, no fantasy. Just math and the mindset shifts that make the math work in your favor. Start with $500. Add $300 per month. Assume 12% annual return. Conservative for these 3 stocks over 20+ years. After 10 years, $72,000. After 20 years, $310,000. After 30 years, $1.1 million. That is it. No lottery. No inheritance. No side hustle required. Just consistent saving and disciplined ownership. If you can increase your monthly contribution to $500, you hit $1 million in 25 years. $1,000 per month? 18 years. The numbers do not lie. The first milestone, $10,000. It takes most people 2 to 3 years. Feels slow. Feels insignificant. But this is where discipline is born. You learn to ignore noise. You learn to add during dips. You learn to reinvest dividends. This phase is not about returns, it is about building habits. Skip it and you will fail later. Second milestone, $50,000. Usually reached in 5 to 7 years. Now compounding starts to become visible. Dividends by whole shares. Price fluctuations feel less scary because your cost basis is averaged in. You stop checking prices daily. You start reading annual reports instead. Mindset shift. From trader to owner. Third milestone, $100,000. Around year 8 to 10. Now you are playing with real money. But do not get cocky. The biggest risk here is lifestyle inflation. Upgrading your car, apartment, or vacations because you are winning. Resist. Stay frugal. Keep saving rate high. This is when most people sabotage themselves. Fourth milestone, $250,000. Year 12 to 15. Compounding is now your co-pilot. Dividends alone may cover your monthly contributions. You are no longer pushing the boulder uphill. It is rolling on its own. Mindset shift. From accumulator to capital allocator. You start thinking in terms of yield, not price. Fifth milestone, $500,000. Year 16 to 20. Now you are halfway to millionaire status, and the second half comes faster than the first, thanks to compounding. Your portfolio generates $3,000 to $5,000 per month in dividends, even if you stop working. But do not stop. Keep adding. Keep reinvesting. Final milestone, $1 million plus. Year 20 to 25. You have won. Not because you are rich, but because you have proven something more valuable. That discipline, patience, and simplicity beat genius, luck, and complexity. You can now live off dividends if you choose, or keep compounding into generational wealth. The key mindset shifts. 1. From how fast to how long. 2. From what is hot to what is durable. 3. From I need to be right to I need to not be wrong. 4. From more stocks equals safer to fewer, better understood stocks equals safer. 5. From I am investing to get rich to I am investing to stay free. Increase your savings rate, not your risk. The fastest way to accelerate wealth is not chasing higher returns. It is saving more. Cut subscriptions. Drive a used car. Cook at home. Invest the difference. A 15% savings rate beats a 10% return with 5% savings every time. Ignore comparisons. Your neighbor's crypto win? Their inheritance? Their startup exit? Irrelevant. You are not racing them. You are building a system that works regardless of luck, connections, or market hype. That is true freedom. This is not a sprint. It is a lifelong walk. But if you keep putting one foot in front of the other, buying, holding, reinvesting, ignoring noise, you will look back in 20 years and realize you did not just build wealth. You built a life that no market crash, job loss, or economic downturn can take away. If you are still reading, you are serious. And that is good, because this is not for dabblers, gamblers, or people looking for shortcuts. This is for those willing to do the boring, unsexy work of building real wealth. Slowly, systematically, and without fanfare. Let us end with the final reality check. There are no secrets, no hidden tricks, no guru formulas, just systems proven, repeatable, accessible to anyone with discipline. The 3 stocks we have discussed are not picks. They are case studies in durable capitalism. They represent ownership in businesses that solve essential problems, generate predictable cash, and reward patient shareholders. You could substitute them with other companies that meet the same criteria: high margins, low capex, global reach, shareholder-friendly management. The tickers do not matter. The principles do. You do not need more information. You do not need another course. You do not need a perfect entry point. You need to start and not stop. Open a brokerage account. Set up automatic transfers. Buy your first share. Reinvest the dividend. Repeat. That is the entire system. Everything else is noise. The market will test you. It will drop 30%. Talking heads will scream, crash. Friends will brag about their crypto wins. Relatives will ask why you are missing out. Stay silent. Stay steady. Stay invested. Your victory will not be announced on TV. It will be realized quietly years later, when you check your balance and realize you no longer trade time for money. This strategy works not because it is clever, but because it is ignored. Most people want excitement. You want results. Most chase performance. You chase durability. Most react to headlines. You follow fundamentals. That is why you will win, not because you are smarter, but because you are more disciplined. If you do nothing else after watching this, do this. 1. Pick one of the 3 stocks. 2. Buy $100 worth today. 3. Set up a $50 per month auto-invest. 4. Turn on dividend reinvestment. 5. Do not check the price for 6 months. That is it. No more research. No more hesitation. No more waiting for the right time. The right time is when you start, not when the market is perfect. And now, if this made sense to you, if you are ready to stop gambling and start building, do me a favor. Like this video, it helps the algorithm show it to others who need it. Subscribe, because I will be breaking down more real, no BS wealth building systems every week. Comment system below so I know you are in this for the long haul, not the hype. Share this with one person who is tired of get-rich-quick lies and ready for real results. You do not need luck. You do not need millions. You do not need to be special. You just need a system and the discipline to follow it. Start today. I will see you on the other side. Millionaire status, achieved the boring, reliable, math-backed way.